Welcome to 3 and 3. Today we're going to be talking about elections, international versus US stocks, and long-term averages. So elections. Presidential elections are important, but can actually distract investors financially. Market returns vary by the president in power, but there's no clear or consistent trend that emerges. Returns are far more correlated with economic cycles and are mostly positive despite the party in power. As you can see, the stock market and presidencies going back to 1933, the presidential cycle is not as important as the economic cycle. And typically, again, you're seeing a trend where even if a Democrat or Republican is in power, the stock market goes up. So looking at this chart, you can see presidents in the stock market. On the top is going to be your Republicans. On the bottom is going to be your Democrats. And the averages are within probably 0.5% over the last 80 years or so. Now, certain presidents had a better average in the stock market, but again, that correlates more to the economic cycle than the president themselves. International versus US. So the US stock market has risen to all-time highs following the first rate cut of 50 basis points. Tech-related stocks have recently been the top performer. But more recently, we have seen the market broaden out. As we look at developed markets, they've trailed the US markets over the last decade, even though there's been some improvements in fundamentals. And emerging markets have truly underperformed. They've faced challenges due to geopolitical conflicts and economic uncertainty in many parts of the world. Now, long-term, emerging markets still play a very important role in portfolio diversification despite recent uncertainty. As you look at the prior 2 years of the US stock market at 62.3% and compare that to the developed markets at 44.8 and the emerging markets at 34.3, this does not actually show up in the long-term averages as something that is sustainable. So looking at those long-term averages, it is important to look at them over a long period of time. If you look at the S&P over the last 10 years, it's averaged 13.99%. And the last 15 years at 13.98%. Comparing that to developed markets at 6% and the 15-year at 5.59, and emerging markets at 3.35 and the 15-year at 2.83. This is why some actual forecasters believe that developed markets and emerging markets represent some of the best opportunities over the next decade for investors to make returns above US indices. Looking again year to date, you can see the S&P is up about 22%. Compared to the Europe, Asia, Far East Index at 8.2, and also the emerging markets at 13.3. Thank you for joining us for 3 and 3.